is at the CME in Chicago. Hey, Rick.
Yes, good morning, Joe. Empire, a February read, one of the more contemporary numbers we get. Expected to be minus 18, comes in multiple times better, but still a negative sign. Minus 5.8, minus 5.8. In the rearview mirror, minus 32.9 was the weakest since May of 2020. So this is a nice reprieve. This would end up being the best number since November of last year when it actually was positive. Now, let's go to January retail sales. Probably the other side of the equation to yesterday's inflation data, expecting a headline number up 2%. And surprisingly, it's better. It's up 3%. And this is a pretty good number considering 4 out of the last 6 months have had negative signs in front of them. Up 3% is the strongest number that we've had since October, which was the last time we had a positive number, which was 1.1. If you strip out autos, and by the way, autos also, minus autos also negative 4 out of the last 6 months, expecting up 0.9%. Almost triple that, up 2.3%, up 2.3%. That is the strongest read, boy, going all the way back to March of 21. So a very good number. And if we strip out autos and gas, also expected up 0.9, it was up 2.6. 2.6, and that's the best number in that series also since March of 21. And finally, the control group, which is used for other economic data points up the economic food chain, so to speak, expected up 1%, is up 1.7%. 1.7% is the best since January of last year, so let's call it a one-year high. Retail sales in all forms today is better than expectations, actually by quite a distance. We see interest rates, 10-year was at 3 3/4. It has moved up a bit, a basis point and a half or so. The pre-opening equities have had some volatility in the Dow futures to the downside, but they've come back to right about where they were, right around 34,000. And this, of course, has the negative connotations, Joe, that we hate to talk about. Bad is good, good is bad with regard to the economy. But no matter how you slice it, yesterday's numbers were hotter than expected, but cooler than the last look. And today, pretty much everywhere you look, it is better than expected. So pricing pressures still historically by wider than 1 year, still higher than most would like. And the growth going along with it still looks pretty decent, though pretty much every source I have looking at first and second quarter data, looking for GDP to be, as Steve Leisman put it yesterday, maybe less than an integer. Joe, back to you. Basis point and a half, and I see you actually are right. We actually take it out that far. I could use a little bit. Can we get 2 more decimal places? I think would really give us more insight into what's happening. Steve Leisman joins us now with more. How many would you like? A few more decimal points, Steve? Or I think we're good here.
You mean on GDP?
No. On the bonds, I was looking at 3.7724, almost like pi. Go out 10.
I don't talk about my investments. I don't do much in terms of, but I like the 2-year and the 6-month. Those are, better than losing your money. I got to say, take it home
688 now 69. Yeah,
taking home 470, 480, whatever it is. But Joe, I want to talk about the gap, not the clothing store, but the gap between the Fed and the market, which at this moment is at an all-time low of 1 basis point for the year-end 2023 contract. We have the Fed and the market right on top of each other at 512 precisely. So remember, there was this 80 basis point gap between the two where the market was building in cuts. Those cuts are gone. They're yesterday's news. And more interestingly, on top of that, looking at where the peak funds rate is right now for it looks like it's the August contract, now trading at 529. And I want to give you one other piece of data on top of that. I just got to look it up, which is the probabilities for the June. We're now trading over 50% probability that we're at between 5.25 and 5.5 now for the June contract. So the market actually getting more hawkish than the Fed. However, today's number is important for the following reason. Yesterday, we had only higher inflation than we hoped for. Today, we got higher inflation and better retail sales. And I think the story today might be, with this big number, an upgrade to the GDP outlook. And now this camp, remember you had the soft landing, hard landing camp? There's this new camp called the no landing camp, that we're not going to bring down inflation. We're not going to cool the economy. I will tell you, my knowledge of the Fed is that is not an option. The Fed will not abide no landing when it comes to inflation. They will abide no landing if it comes to the economy and no recession. So that means, and this is where the market is trading right now, and I'll finish my screed after this, it means higher for longer. Not just high for longer, but higher for longer if indeed inflation does not cooperate.
If I offer the Fed a deal, 3 and
Okay.
3 and 3, 3%
3%
GDP,
Nice.
3% GDP, 3% inflation.